My name is Kevin Patrick, and I work at the Economic Research Service, which is part of the USDA. And as Chris said, I'm going to cover the USDA's Farm Income and Wealth Statistics data product. And specifically, I'm going to talk about the 2017 forecast for the financial condition of the farm sector, and then also take a deep dive into some data visualizations that the USDA publishes looking at historic data for the farm sector. Before I can talk to you about the financial condition of the farm sector, I want to briefly talk about what is the farm sector. So the farm sector is comprised of more than 2 million farms, and these farms operate over 900 million acres of farmland. And to put that in a little bit of perspective, if India, which is the 8th largest country by land area, if they converted every single inch of land to farmland, they would still be more than 200 million acres short of what the United States dedicates to farmland. So there's really there's a lot of land dedicated. And then I think arguably the most important thing that I think about when I think about the farm sector is that it in some way supports more than 6 million people living in farm households. All right, so that's the farm sector. Now we can talk about how we actually the USDA releases data related to the farm sector. And we do that in a data product called the Farm Sector Income and Wealth Statistics Data Product. And we focus on data related to the income statement and data related to the balance sheet, and then a combination of the two using financial ratios. So we release historic state-level estimates for all 50 states. We take the combination of those 50 states and release a national historical estimate for many of the income and wealth pieces of data. And then we also do a national forecast as well. Here's a timeline of when we release the data. This is specifically for 2017, but the general idea works for most years. So in February, and in this year on February 7th, we released our first forecast for 2017, and this is the most up-to-date farm financial information that's for this data product. Over the next couple of months, we'll gather planting information, weather information, sales, all these kind of survey information from different federal agencies, and we'll update our forecast in August, and this year on August 30th. We'll update our 2017 forecast, and then we'll convert the 2016 forecast into what we call a historic estimate. So we'll, at that point, have 2016 state-level data available. And then we'll continue to gather some harvest information, more price information, all the information we can gather, and then we'll make one final update of 2017 in November. And this process gets repeated every single year. Okay, so now you have an idea of what the farm sector is. You know what the actual data product that the USDA releases to describe it, and now we're ready to actually describe the financial condition of the farm sector. And the focus of the first 10 minutes or so of the presentation is going to be on the forecast. So what does the USDA, what is the perspective for 2017? And we're going to talk about it in 3 broad metrics. Okay, and we're going to talk about it in 3 broad metrics. The first is profitability, and specifically we're going to focus on net cash income and net farm income. Then we're going to move over to the balance sheet, and we're going to take a look at solvency and take a look at debt and assets of the farm sector, and then combine the two to take a look at the debt to asset ratio. And then I will conclude the kind of financial condition forecast of the farm sector by looking at liquidity for the farm sector, and specifically looking at working capital. The first thing I'm going to take a look at is profitability in 2017, and based on the information that we have as of February, depending on the metric that you use, the results are mixed. So for net cash income, is forecast in 2017 relatively flat, relatively stable, and net farm income is forecast down. So that's why we're saying that it's mixed in 2017. I'll go over why there's a difference in the two. And then below it is a broad kind of 5-year looking back trend. So you have an idea that we're coming over the last 5 years, profitability has been weakening. So here's net cash farm income adjusted for inflation. So everything is in 2017 dollars. And it's just the first thing that you'll notice all the way to the right is that net cash farm income is forecast at $93.5 billion in 2017. This is essentially flat compared to 2016, though it's down significantly from the highs in 2012 and 2013, and also below the 10-year moving average. But if you compare where we're at, where we're forecast at in 2017 to the 2000s, while we are down from 2012 highs, we're sort of back to where we were on average in the 2000s. So it's important to have some, to take a longer perspective than just where we are from a couple of years, to take a little bit broader perspective. And I've layered over on top in orange the net farm income. And the difference between net farm income and net cash income is that net farm income includes non-cash income and expenses. So things like value of inventory change and economic depreciation get included in net farm income, but not net cash income. So net farm income is forecast at $62.3 billion in 2017, and this is down from 2016. But though the story over the long term is very similar to that of what's happening with net cash farm income. And I'll take a little deeper dive into net farm income, the forecast in 2017, and how it differs from where we were at in where we're forecast at in 2016. So this chart is known as a waterfall chart, and all the way to the left we have the net farm income forecast in 2016, and all the way to the right we have the net farm income forecast in 2017, and which is forecast $5.9 billion down. And if you look in the middle, these are the major components that are driving this $5.9 billion change. And the two things that really jump out, or things I want to point out, is the forecast decline in crop inventory, and the other is indemnities. So for indemnities, this is something that we're not forecasting that indemnities are going to necessarily rise. We're just taking a long-run view of indemnities because they're so volatile that what we're basically saying is that we're taking an average, and that 2016 was a particularly good year, so there were less indemnities paid out. So that was a very, very quick overview of profitability. We're going to slide over to the balance sheet and take a look at solvency. So this is a long-run view of of farm assets, and everything is inflation adjusted to 2017 dollars. And the long-term sort of interesting thing I think with this is that it's very apparent that the majority of farm assets come from real estate. So the land and the buildings are over 80% of total farm assets. And if you look kind of more towards the right, the more recent past, there's been a significant incline in the value of farm real estate assets, and we're forecasting over the last 2 years some declines, but relatively small declines in both real estate and other farm assets. The other side of the balance sheet is debt. So we're taking a look at farm sector debt, which is forecast at $395 billion. And again, this chart is inflation adjusted to, so everything is in 2017 dollars. And oftentimes people ask, how does today, what's happening now compare to what's happening in the 1980s? And so we can take a quick look at that when you're, so total farm sector debt is still below, is approaching, but is still below the debt levels that we're seeing in the early 1980s. But real estate debt, debt secured by real estate, is actually, in inflation-adjusted terms, $21 billion above the highs that we're seeing in the 1980s. And for non-real estate debt, it's not approaching the highs in the 1980s, and is actually been forecast relatively stable over the last couple of years. Another thing that's sort of interesting or important to keep in perspective comparing today to the 1980s is that interest rates are very different than they were in between the two time periods. And this might be a little bit tough to see, but the average interest rate for farm debt in 1981 was 11.2%, and today the average interest rate is 4.8. So the amount of interest that actually has to be paid on this debt is a lot less. Okay, so if you combine debt and assets together, you get what's known as the debt-to-asset ratio, and it's a measure of leverage or solvency. And it's been increasing since 2012, and is the highest it's been in the since 2002, though it's still well below the historic highs in the early 1980s. And the main reason for that is that farm, and particularly farm real estate assets, have increased so much, and they haven't declined significantly so far. Okay, I'm going to very quickly go over liquidity because I think I'm running a little bit low on time. And so basically, the liquidity measure I'm going to look at is working capital, and that's current assets. So the amount, you can think about it kind of like the assets that are either cash or can be likely converted into cash within a year is what we call current assets, and those are forecast down $87 billion between 2012 and 2017. Current debt, which is the debt obligations that are likely to become due in the next 12 months, those are forecast $30 billion higher. And if you take current assets minus current debt, you're left with a liquidity measure called working capital, and that is forecast to shrink between 2012 and 2017. So I kind of rushed through that, but I did that because I want to have at least a little bit of time to get into moving away from the forecast and looking at all of the really rich data that we have on historic farm sector income and wealth. So we have three data visualizations, so I'm going to cover. We also have tailored financial reports, so income and balance sheet statements. We do forecast analysis webinars, similar to the one that we're doing right now. And we also have current and archived comprehensive data sets of every single piece of data that we've put out over the different data releases. So what I'm going to take a look at is the three visualizations really quickly to kind of show, for people that are new to this data, some really easy ways to access and get familiar with some of the data that we have available. So this is what we call an interactive visualization that we call Get to Know Your State. And you basically can pick a state. So I'm going to just pick Washington State here. And you can choose the year, but I'll just leave it at 2015. And you really quickly, I guess I picked California instead of Washington. We can do California, that's fine. So there's someone from New Mexico. We can pick New Mexico. So you select New Mexico, and you quickly get kind of some just really general information about the farm economy in that state. So there are approximately 25,000 farms in New Mexico. They farm a little bit over 43 million acres, And in 2015, they had net farm income total of just under $800 million. They received about $80 million in government payments. And then you can, if you scroll down, you can get kind of how they ranked in terms of a bunch of different metrics. So as far as net farm income, they're the 28th. In 2015, they had the 28th most net farm income. But you can also see various different things. So in terms of the acres of farmland, they have the 6th most farmland. And then along the bottom, you can check out the top cash receipts for New Mexico, which is, I didn't know this off the top of my head, but it's apparently milk, and then cattle, and then pecans. And then you can also see where they're spending most of their top expenses as well. That's a really brief overview of the Get to Know Your State. We also have a visualization called the Farm Income Atlas, which you can delve deeply into the farm sector income statement. And you can look at cash receipts by commodity. You can look at other farm-related income they receive. And what I'm going to take a look at is government payments. And so we can get an overview of what total government payments, federal government payments look like, or if we want to take a look at where ARC payments primarily located. So you can quickly get a perspective that it's kind of in the Corn Belt, and sort of makes sense. Most ARC payments went to corn or are forecast to go to corn. And you can also get a tree map, which is on the left there, to kind of get a perspective of the percentage, and then also a bar chart. And you can look at other government payments as well. So let's say we wanted to see PLC, which is primarily going to be in the south and southeast, because it's mostly going to rice, long grain rice, and peanuts and wheat. So, and then for just to kind of rushing through here, just to show you everything we have, then we have digging into the balance sheet, so you can see a bunch of different information about the balance sheet. And the example I'm going to show is really briefly land values. So you can get a perspective of where the highest land values are, and something that some people may not think intuitively, where the highest farmland values are actually in the Northeast. In New Jersey and Rhode Island have the highest average farmland value, and that's likely due to reasons other than farming. So you can, let's say you wanted to see what does it look like if you remove the Northeast. You can remove the Northeast and everything readjusts. Oh, so it's apparently it's wasn't loaded. And so then you get kind of a perspective of what are the hot areas for farmland and percentage changes over time without the Northeast. And you can, so this is kind of, it's meant to be what we call a guided interactive visualization. So it's interactive in that the user can pick whatever they want, but we attempt to guide, tell a story sort of with the visualization. So with that, I'm going to call it. And if you have any questions, I'm happy to answer them.